Andy Jacobi joins the show today. Andy is the co-founder and partner at Jacobs Franchise Partners. After business school, Andy went and started his own restaurant in the heart of New York City and has been in operations and finance at several independent, fast-growing chains. He brings a ton of experience. And in this episode, we kind of unpack why he's now in the franchising game, some of the lessons he learned running his own independent restaurant, which I find really fascinating, and now his ambitions and growth opportunities that he sees in his franchise platform. Hope you enjoy. Andy, welcome to the show. How are you doing today?
Doing great. Thanks, Daniel.
Absolutely. Thank you. Thank you for joining us. And, we were talking earlier about your journey to, starting off, and I want you to talk to our audience about it because I think it's a really good example of anyone from any background could become a franchisee, could start even a restaurant themselves. Want to take us maybe back to when you were in business school, right? So, or even before that, you worked in finance. Is that correct?
Mm-hmm. Yeah, that's right. Sure. Yeah, I'm happy to walk through my background. So yeah, I started my career straight out of college in finance. I worked in investment banking and private equity for 5 years. It was a great way to start your career, but I could, there was something about the food industry that was, or
Speaking to you.
food and beverage and restaurants, I guess, that were always a passion of mine. So I found myself even when I was in finance. My last couple of years, I was working for a generalist private equity, private debt shop. I found myself kind of always gravitating towards food related deals. And I thought that was a good sign that a career pivot was in order. I then did go back to business school though, but with the intention of coming out and doing something more entrepreneurial. I had worked in restaurants kind of as a kid, kind of to make money, but I had never taken it very seriously, but decided coming out of school to start a restaurant with a friend. I had been working part-time while I was in business school, helping a grass-fed meat company build up a business on the East Coast. And one of my customers was a chef, and we started talking about a sandwich shop concept that became Untamed Sandwiches. So I graduated from business school in 2012, opened up our first location a couple years later. First couple did quite well. Then we opened up a couple more and they didn't do so well. So around 2018, 2019, we decided to start selling off the business. It was, an amazing experience and a great learning experience. I obviously wished it had legs to really scale much bigger than just 4 locations. And I think what happened with like locations 3 and 4 is I think we started to realize that it was not as scalable of a concept as we had hoped. Sold that off in 2018, 2019. And over the course of the next 5 years, I worked for a few different brands. I started out working for a company called Tayin, which is a Mediterranean concept. I led operations for them for the year leading up to COVID. COVID put a real hurt on that business where kind of all of their locations were central business district locations.
Right.
So moved on kind of at the start of COVID as we were kind of furloughing all of our employees and closing down locations. And I moved over to a company called Stickies, which is a fried chicken and French fry concept. At the time, we had 10 locations open and we got up to 14. I was the CFO there for a few years. Again, great business in that, everyone loves chicken and it's a very high margin business model. But of course, also heavy exposure to New York City during a time when that was challenging. So I think we got the business to a good spot, but really needed capital to be able to expand dramatically beyond the New York City footprint. And for various reasons, we were just never able to get that over the finish line. So I left Stickies in 2022 and moved to Chicago, in part for a role, in part for family reasons. But I then led the finance function for a company called State of Play, it's a UK based company, but the US headquarters were here in Chicago. And State of Play is a social entertainment holding company. So there are 3 concepts in the stable. One is Flight Club, which is a darts concept. One is Bounce or Ace Bounce, which is a ping pong concept, and one is called High Jingo, which is a video bingo concept. What all of them kind of did similarly was it took a simple game and paired it with really good food and beverage,
Right.
as well as technology to kind of enhance the gameplay and automate the scoring, and put that together in a package that was really attractive for a corporate audience, especially.
Yeah, that makes a lot of sense.
Yeah, and it was at a time also, 2022, we're kind of coming out of COVID. Every business is saying, how can we get employees to come back to the office, and how can we create meaningful interactions with our teams and with our clients and customers? And State of Play, I think, was really well positioned for that. There are a lot of companies that were trying to become the next Top Golf and really appeal to that corporate audience who wanted more than just, to go out to a bar. So I was there for only about a year and a half. It was, you know, learned a ton. It was a really interesting business model. But I think ultimately what led me to leave was it had been at that point, I guess, 6 years since I had sold off Untamed. And I think I was just starting to feel this itch of entrepreneurship, of wanting to kind of get my hands dirty and do something entrepreneurial again. Untamed was both an incredibly rewarding as well as challenging experience. I think one thing I learned, and every time I counsel an aspiring restaurateur who's thinking of opening up a single unit, new concept, fast casual restaurant, is it is so hard to do. The probability of actually getting to a liquidity event is so low that it's just a really tough thing to do. I don't think even like with my life experience and career experience at this point, I don't think I would ever do that again. But what happened about a year ago is I started talking to a friend of mine who had, funny enough, also opened up a different sandwich shop concept a couple years before me in New York about a franchising opportunity. And specifically at the time, he was looking at a couple of portfolios of Popeyes in the Chicago area. And, we started talking about franchising and what these businesses had going for them and what we could do to enhance the margin profile of the businesses. And that deal ended up not working out. But what came out of that, I think, was a great partnership. I think Michael, my friend who kind of brought that opportunity to me, really kind of showed me how attractive the franchising model is if you're in the right concept. And it seemed like a really cool opportunity for us to apply the skills that we had built up over the course of the prior 15 plus years, and to apply it to a business model that just had a much lower risk profile than investing in independent brands. Like both of us had spent so much of our careers building and supporting and managing independent brands. And we're excited to not do that again for a while and to instead focus on executing on already proven concepts.
There's a lot there that we can double tap on. I think you brought up a really good point in that the decision that a lot of restaurant owners and operators have to make is whether, I want to go independent and have that freedom, that control, versus going down the franchise model where it's less risky, right? There is a playbook that you're given, but from conversations I've had with some operators, you feel less of the creativity, less of the spark, less of the control over where you want to take that business. Now, there's a new concept that I think has been popping up a lot these days. I don't know if you've heard this, but they call it the modern franchise. And this is small independent shops that are able to take the operational like excellence and the blueprints and the tools that are given to you as a franchisee and apply that into your business. So there's companies that offer delivery that you can do yourself. You don't need to have an entire infrastructure, for example. All these back of the office tools, front office tools, that makes it so easy to, or at least easier to run a business. I know it's a tough business as it is. If you were to look at that decision, going back from where you were in business school, right, coming out of business school, do you think with all this hindsight that you have, you would have still taken that same direction of opening up your own restaurant first? Or do you think you would have been going down the path of franchising and looking at other investment opportunities that are less risky?
I think I still probably I mean, I would have done what I had done because I was, a foolish, whatever, 25-year-old. That was what you do when you're a foolish 25-year-old. But I think that it's a good point. I mean, there's so many off the shelf software tools, especially, that I think make it kind of easier to run a restaurant these days, or
Easier is the
certainly
word.
give you.
Easier. Yeah.
Yeah, well, and I mean, it's certainly, I use that term cautiously because it's not easy.
No.
But I think there are frameworks that are available today through, off the shelf SaaS tools that I think were not available back in 2012 when I first opened Untamed. But at the same time, I think what you can't replicate that you get from being a part of a really good franchise is a brand that you just know is going to work. So I'll fast forward to the point that we're now engaged with Jersey Mike's. We have a 3-store development agreement here in Illinois, and we're in the process
Congrats.
of building those out. And I can tell you more about what makes Jersey Mike's a brand, one of a few brands that we really like and that we're really interested in. But what you get with Jersey Mike's is an understanding that it's going to work because it's worked 3,000 times before across all kinds of different markets around the country. And when you're building an independent brand, I've been a part of some independent brands that really kind of caught fire with a few locations. And you're doing these AUVs where you're like, oh my God, I'm
Right.
doing as well, if not better, than the big national brands. Like, this is amazing.
Right.
But the
For that
question is,
specific region.
yeah, yeah. And maybe
Yeah.
with like, 3 or 4 or 5 shops. The question is, can
Mhm.
you sustain that? Can you do that with 100 shops? Can you do that when you are going to a market that is, a completely different market than the one that you started in? There's all kinds of local champions out there that they're doing great things, but oftentimes what happens is their AUVs really stumble when they try to move to another location. And to work with an operator that's already, or not an operator, but to work with a franchise that's already met all of those milestones and has a national brand recognition that just transcends boundaries of or regions of the country, gives you a level of comfort that it's going to work in a way that even the best SaaS tools supporting a really creative person opening a single restaurant are not going to replicate.
So, Andy, let me ask you another question here about when you're looking at different brands to go into, to invest and to open stores, there is a certain playbook of finding a brand that's rising, right? Same like year over year store sales, opening up new locations, good brand identity. And there's also other brands that I think investors or franchisees are looking at that might be a little bit on a decline. You can buy it at a discount with the hopes, of course, it's going to rebound. What would you say is your philosophy around finding new brands that might be potentially trading at a discount?
It's there's so many ways to get into franchising, I guess. There's so many ways to think about how do you run a franchise profitably. And I think in the early days, we were looking at a number of deals that were kind of brought to us by brokers, which oftentimes were brands that were maybe a little bit lower growth, or maybe brands
Mhm.
that weren't really focused on development, where really the opportunity was you buy a portfolio of
Right.
restaurants for a set multiple of LTM EBITDA and you put leverage on it. It's a typical kind of like leverage buyout model. You put leverage on it, you try to eke out a few points of margin, and ultimately you look to sell it in 5 or 6 years. We looked at a number of deals like that, and not to say that there's anything wrong with that. There are certainly a lot of investors who are getting into those kinds of deals and thinking about it much the way that you described it. It's kind of like you're buying an asset at a value, and you're
Mhm.
hoping that you can grow EBITDA over time.
Right.
Maybe you see some multiple expansion. Maybe you get to a point where you can also make additional tack on acquisitions and you can sell it at a higher multiple. Our fear was that a lot of these brands, every brand still wants to grow. Whether or
Right.
not they're growing now, whether or not they're growing their store count now, every brand has ambitions of growing. And we didn't want to get into a position where we were buying assets and signing development agreements that we never intended to fulfill, which is what I
Mhm.
think a lot of franchisees do. And this is kind of the wink, wink, nod, nod
Interesting.
of the industry now is if you buy into certain brands, they might say like, yeah, if you buy these 10 locations, you got to sign a 5-store development agreement. and then you try your best not to actually execute on that
I
5-store
see.
development.
I see.
Our view was we wanted to be in a brand where it really just made sense to develop. So we look at 3 criteria for the brands that we invest in. One is we look for brands that are really well established. So we want to be in brands that have at least 1,000 units in operation. 2 is we look for brands that have really good development economics, which we define as 30% plus cash on cash returns for new builds. And not only that, but also ones that have opportunities to develop. And then the third one we define as loosely as just a strong history of same store sales growth. It doesn't necessarily mean that they have grown fantastically over the last few years. So I think some of the brands we like have kind of hit a plateau maybe over the last 2 or 3 years. And maybe that has an impact on multiples for new acquisitions, which we like. But at the same time, we know that there's great opportunities to develop. And oh, by the way, something about brands that have really good development economics is the reason they have good development economics tends to be that they have really strong EBITDA margins. So that's kind of the balance of having good cash on cash returns. Is part of it is they've been really disciplined about keeping their build out costs low, but part of it is also that the amount of EBITDA that you generate from a unit is pretty high.
Right.
And so those also tend to be businesses that are a little bit more resilient, a little bit more, where the risk adjusted return is better.
Mm-hmm.
So that's, Jersey Mike's is kind of case in point with that, where it costs about $650,000 to
That's
build
right.
a Jersey Mike's. Their
Quite cheap,
AUVs
I would
right
say.
now are, sorry?
Quite cheap, I would say, in comparison to
Yeah, I
other
mean,
fast casual QSRs you can get into.
definitely. If you compare that to all of the legacy brands that rely on standalone pad sites and drive-throughs, it costs about a third to a quarter of the cost to build a Jersey Mike's. And at the same time, they're generating north of $1.3 million in sales per unit. So the payback period on that is fantastic.
Fantastic. Yeah.
And that's really what excites us about Jersey Mike's.
Mm-hmm.
And again, they have 3,000 units, but their ambition is to grow far beyond that. And we want to be, one of the franchisees that's really growing alongside them in a very thoughtful and measured way, but in a way that allows us to take advantage of our skill sets and grow this to be a significant business.
And typically we see that the pathway to growth is through acquisition, right? Acquiring stores and building up your portfolio that way. But in order for you to acquire stores, one thing that I've learned from talking to you is that it's not that easy, right? You need to have had a relationship with the franchisor, the development people, and you need to have a foot in the door. How were you able to get into the Jersey Mike's network? And have you had any, let's say, challenges or challenges or just like interesting opportunities that you probably weren't able to get given the fact that you're still kind of starting up in the franchising network?
Yeah, it's a good question. I think every franchisor is different. Every franchisor, I think, has a different view of what the ideal franchisee looks like. Every franchisor interacts with their franchisees in different ways, provides different levels of services, different kinds of services, charges a different franchise fee, markets in a different way. And
Absolutely.
so a lot of this information is available in the FDD. Not that you need to actually read through 300 pages of
Right. You can
material,
control F it.
like,
You can find
yeah,
what
exactly.
you need to.
You can, one of the things that Michael and I do is we keep a database of the basic facts, the economics of a whole bunch of franchisees. And we're constantly looking at kind of how that's changing and whose payback periods are improving, whose are getting worse. And all this is available through the FDDs. And so for us, we did use these criteria to really say which brands do we want to be a part of? And then we got to work reaching out to those brands and seeing if there were opportunities available. Jersey Mike's is really unique in that they haven't really allowed outside acquisitions into the brand historically. So really the only way in is to develop. We tend to look for brands where we can make an acquisition. But to your point, acquisitions of franchisees are really challenging because you need to have the approval of the franchisor. You need to come to a deal with the franchisee. You need to line up financing, do all the things that you would need to do with any kind of acquisition. But I think the fact that it's this 3-sided deal between franchisor, franchisee, and buyer makes it particularly challenging.
Mm-hmm.
And part of our business model with Jacob's franchise partners is that we look for these acquisitions, but we know that we're going to lose, in any given process, we're probably, the odds are we're going to lose. So it's about kind of building the pipeline and building
Right.
those relationships with franchisors so that we do have a kind of a constant deal flow coming in, and we can kind of run these deals through our screens and see if it's something that fits our criteria.
Absolutely. Yeah. Get as many reps as possible, get the at bats opportunities, and just make yourself known in the industry. How are you doing that? Where are you going? Where are you hanging out? How are you getting in front of these franchisors?
Yeah, it's by any and all means necessary. In some cases, it's cold outreach. In some cases, it's asking if we find out that we've got a close friend who has a relationship with, someone on the development team at a brand. We'll see if we can make a connection that way. Michael and I also go to various conferences around the country. We're not quite as well traveled as some people on the conference circuit, but we make it to some of them. And those are great opportunities oftentimes to get in front of franchisors and meet people and find out if you're a fit for what they're looking for in their franchise base.
Makes sense. Makes sense. Yeah. What would you say is, I would love to have maybe Michael on the show one day, but your two skill sets, right? What do each of you guys bring to the table, and what is your working relationship like? What's the dynamic there?
So both of us have had partners in the past. So we've had the opportunity to really think about what makes a good partner. I think for Michael and I, we've been in the same industry for a long time, but we've done kind of different things within that industry. I've tended to focus on operations and finance. Michael has done a lot around real estate and technology, but obviously he started his own restaurant concept just like I've started mine. So both of us are kind of used to rolling up our sleeves and getting things done. But we've also kind of established kind of different lenses in which we look at the business. But what I think really ties our partnership together is I think we have a similar way of kind of looking at the world and similar goals for what we want from the business. And when you have that, and also I think when you have just a genuine like and respect for your partner, you work your way through problems. You find out kind of how to get things done. We don't necessarily have like hard and fast rules for how we make decisions. Just generally it's about talking it over. And if one of us feels really strongly that we don't want to do something, we don't do it. One of us has really high conviction and the other one doesn't. The one that has the high conviction will definitely work hard to try to convince the other one that this is a good position to take. And, Michael's changed my mind plenty of times in terms of things we should be doing that we're not doing. So it works. And I think by having that kind of open mind and respect for your partner, and also just kind of like, I think both of us are intellectually curious people that are aware that we're not going to be right 100% of the time. It creates a good working relationship where we do the things that as a partnership, we agree are the right things to do.
Yeah, I love that. It's always amazing to get someone else's perspective on the types of partnerships that you should be looking for. And I think that every single founder, every single partner has a different answer to that question. But one thing I've seen is time and time again is that you need to be able to have disagreements, but be able to get through those disagreements in a productive and healthy way. And again, also your background in finance and operations and Michael's background as well. And, you said technology and also starting his own brand. You guys come together as, I think, a really good package for the franchisors that you're talking to. And one of the goals of this show is to put a spotlight on these, what I call modern operators, people that are entering the space, maybe in non-conventional ways, you might say, and are trying to grow their business and honestly do right by their guests and do right by their employees. If you had to look, let's say 5-10 years from now, at the beginning, you mentioned the realization with Untamed is that it was way too much hustle for a very, very small chance of liquidity. What is the goal here with, I'm going to call it JFP. I'm going to stamp that. What's the goal with JFP here? What would be a success in your eyes? And what are the steps that need to happen in the next 5-10 years in order to accomplish that?
We want to continue to, I don't see kind of a date in which JFP doesn't continue to invest in restaurants. We think of these kind of the way that we approach each brand as being kind of a discrete opportunity and deal. And we have investors. We're going to need to,
Right.
build up assets and then create liquidity for our investors at some point. But I think for Michael and I, this is the industry we love as well as a business that we believe deeply in. So our intention is to kind of keep doing this over and over again. We want to do it with Jersey Mike's now. We have a few other brands that we're talking to quite a bit, and hopefully we find opportunities with them as well. And to keep kind of utilizing these skill sets that we've developed to build great businesses within really successful franchises.
Makes sense. Yeah, makes sense. And it's always interesting to talk to operators that are starting to invest in other hospitality brands that are not food related. It becomes an interesting challenge and a fun opportunity, but it's so much different. I would say the hospitality aspect of it, treating the guests and running a playbook that's time and tested is probably the similar aspects of both of those businesses, but it starts to become, I think, a different type of business model that people might not actually be ready to take that on. So if we're looking at franchising as a whole, other than restaurants, what would be another business that would seem interesting to you?
I think, one of the things that we've learned over the last couple of years is there is a wide universe of franchises.
Absolutely.
Far beyond food and beverage.
Yeah.
Our investors expect us to invest in restaurants right now.
Okay.
And it is it's what we know. It's where we've set up our careers. So it's what we should be doing.
Right.
But we've learned quite a bit about, health and wellness franchises. I think those are health and wellness, I think is one area that I think is really interesting. There aren't a lot of brands that have gotten to the scale that make them really low risk, sustainable investments. But there are a handful that are approaching that point. At some point in the future, I think, Michael and I would love to look at some of those brands and consider investing in health and wellness franchises as well. But for now, I think we're very restaurant focused.
That's a good answer. And I would say that look for, if I were in your shoes, if I was debating going into another franchise, I would look for ones that are tech enabled. So think to, back to your time at the company that was doing gaming. Those are opportunities where you can use technology to reduce operational costs and you can stay on the cutting edge of things. And I think health and wellness is starting. I'm hoping it starts to become more tech enabled. And there's so many other franchising concepts that could come up in the next, 5-10 years that we've never seen before. So I'm really excited about that. And last question for you, Andy. It's been awesome talking to you. I always ask my guests, who in the restaurant world or which operator do you look up to? Who inspires you? Who have you maybe modeled yourself after?
So I knew you were going to ask this question because I've listened to your other podcasts and I was thinking of different directions I could go in. I listened to the podcast with Andy Forsheimer and I've gotten the opportunity to meet him a few times and I think he's an incredibly impressive guy. I think one of the things that impresses me the most about him is that I've met him in person a couple of times. I've sat at a table at a larger group dinner with him. I've listened to his podcast interviews with him multiple times. I've heard him speak at investor conferences in front of, big groups of very deep pocketed investors. And he is the same person every single time. And which is, right. I mean, he's pretty out there. He'll give it to you straight. And I think that's a really, really good trait. Probably the best thing I could say about someone is that they're always themselves. And I love his quote that, whatever you settle for becomes your standard.
Right.
And I think I've heard him say that for years. And I think about that all the time, that it's like every time you're in a restaurant and you think to yourself, like, I think that's good enough. You realize like, that's not the way you can think about it. Especially if you're in a leadership position, you have to walk the walk. You have to be the person that is in the building, with the team, but also the one who's saying like, guys, we have a standard to meet, and this is what it is.
I love it. Andy's getting a lot of brownie points from my guests. I just had Daniela from the Colada Shop, and Andy is one of her mentors.
Oh, nice.
The thing that I love about her and I love about you is that you guys have had the operator experience. You know what it's like to run a restaurant, and she can go in there, and she's a trained chef, so she can go in there, roll up her sleeves, and get right to work if something needs to be done. So I love that. I love that you're able to have the insight into actually running the restaurant, and then by having the roots in the business. And I also love talking to operators have had battle scars, because that always makes it super interesting, right? I think that's a recipe for success. So Andy, thanks so much for joining me on the show. I'm really excited
Thank
for
you,
you
Daniel.
guys. I know I'm going to see you
Thank
guys
you.
on all the tours, and I can't wait to see what's the next brand you guys will enter. But good luck with Jersey Mike's. I think that's an amazing opportunity, and I hope to see you maybe at NRA.
Absolutely. Sounds good. Nice chatting with you,
Take care.
Daniel.
Thank you.